Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what I want to do today is I want to look at 5 different companies in the technology sector that are high growth companies that potentially are undervalued at the moment. General markets have done really amazing in the last, basically since the beginning of the year. So what I want to do first is just focus on that, and then I'll tell you the 5 different companies. So if you look at the S&P 500, year to date is actually up about 16%. Which is really quite good. Normally, the S&P 500 returns about 8% on average every single year. Right now, is double that. When we look at the QQQ, which basically tracks the Nasdaq, okay, it's about 41%. That's huge. So that means a lot of the tech companies in this index, for example, have done absolutely amazing. Now, if we look at the Dow Jones Industrial 30 companies, there's 30 mature companies in here, and they are only up about 4%. So they actually lag in the overall markets. So we will see where this ends up at the end of the year. But based on this, everything seems to be up. So what we sometimes tend to do is, we look at the overall markets, we look at the S&P 500 and say, okay, where can we find a value? Okay, whether it's the technology sector, whether it's the other companies, and today I want to focus on the high growth companies that could potentially be a good addition to our portfolio. But before we do that, it will be really nice if you can join us on the Discord. If you haven't joined us already, join us on the Patreon. You get access to all of these things, including the Sharia compliant investing book. You also have access to the Discord where you can talk to brothers and sisters who are like-minded, and definitely helps the channel. And obviously give the video a like, subscribe to the channel, let me know if you have any questions. So let's jump in straight away to the 5 companies that I want to talk about today. I normally try to, in my portfolio, have a high growth companies, as well as obviously companies that are growing maybe 4%, 5%, 6%, depending on basically the sector. So consumer staples, for example, normally grow about 7 to 8% every single year. You got the healthcare that's slightly faster, you got technology that is way faster, and so on. And when you're building a basically diversified portfolio, you really need to have some high growth companies, and that's what I try to do. Obviously I do like dividend companies, but there are some dividend companies that are actually high growth that are still growing their basically their revenue very fast. So what I want to focus on today is these headings. So we're going to look at the Morningstar Economic Moat Rating, which tells us how competitive these companies are, if they have a basically competition, and if they have a massive competition within basically in that sector, then they would have like a narrow or none and so on. If they basically are the main company that dominate in that sector, they might have a wide economic moat. Now we have the price, the EPS, earnings per share. We have the price to earnings, which tells us how expensive the stock is, but we can't just rely on just the current PE. We also look at the forward PE and see in comparison to current where the company is actually cheaper based on the future earnings. That's the most important thing. That's the reason why we look at the forward PE. Now we also look at, for high growth companies, we need to look at the price to earnings to growth PEG ratio. And I'll explain what that means in a second. And this is something that Peter Lynch actually made it basically famous. A lower PEG ratio is generally a better indicator of a buy. In basically a particular PEG ratio, for example, if it's below under 1, suggests that the stock price is not currently accounting for expected earnings growth. So if the company is expected to grow, I don't know, double digits, okay, the PEG ratio is about 1, that means we're not really taking into consideration the fact that this company is growing very fast. So it's really important to look at that. PEG ratio above 1 normally seems to be maybe a little bit more expensive, but anything below 2, it's okay. Then we got the price to sales. Price to sales basically is a ratio, is a valuation ratio that compares a company's stock price to its revenue. The reason I want to do this and to explain these things is because we have a lot of new investors, and I need you guys to know what we're looking at when we talk about these things. Okay, so compares current company's stock price to its revenue, and that's really important. Based on the revenue the company is generating, is actually is the stock price really expensive or not? It's an indicator of the value that the financial markets have placed on each dollar of the company's sales or the revenue. So what we normally tend to look for is between 1 and 2 and a price ratio with a value less than 1 is actually better. So anything below is 1. Majority of the companies that you're going to see today will have 3, 4, 5. So sometimes that doesn't mean they overvalued, whatever, but again, based on the revenue. So basically, we're placing a lot more on the sales and revenue side of things. Now, in terms of price to the profit margin, again, another thing that we normally look at. So profit margin, I'll come back to return on equity in a second. So profit margin is the measure of your business ability. So it's expressed in as a percentage. And profit margin represented the company's net income when it's divided by the sales of the revenue. Okay. So profit margin actually helps us to understand how much, how much of every dollar in sales or services that the company basically keeps from its earnings. So whatever you've earned, how much of that are you keeping, and that's your profit margin, if you like. And the return on equity, which is something that we normally look at as well, is used to compare financial performance of companies within the same industry. So you basically comparing like for like. If you buy in, for example, let's say MasterCard and Visa, you want to basically look at the return on equity to see if basically which one is better. So it's a measure of the ability of the management to generate income from the basically equity available to them. A return of between 15 to 20 is basically considered good. Anything above that is absolutely amazing. And I think Visa and MasterCard have a high return on equity anyway. So that's the most important thing. And then we also have free cash flow, which is really important. It tells us how much cash the company has that they can use to reinvest in the business to do other things. We got the total return, we got the growth estimate for the next year. So based on the earnings and estimates, what are we expecting from this company in terms of EPS, in terms of basically, and also for the next 5 years, and then Morningstar valuation and the fair valued. So the first company we're looking at is ASML. I've talked about this company lately. It's still undervalued. It has a wide economic moat. This is one of the companies that companies like, for example, TSMC, companies like Intel rely on when it comes to the equipment they need to make the chips, for example. Current price is $637 per share. It has an EPS of $20. Current PE is about 31. The forward PE is about 30. And price to earnings to growth or PEG ratio of below 2, which is really good. And price to earnings is about basically below 10. Profit margin about 29%. Return on equity 80%. Current ratio, which tells us basically how much if the company is able to pay off any debt that company has in the next 12 months. Okay. Anything above 1 is what we're looking for. So it's above 1. Free cash flow, we're looking at about $5.7 billion. And then total return in the last 10 years, we're looking at about 22% for this company, which is absolutely huge. Total return, including, price appreciation as well, dividends. Growth estimate for the next year is about 13%. Then they're expecting the earnings to grow 23% every single year. Right now, it's about 15% discounted. $750 per share is where they expect the price to be. The next company we're looking at, Salesforce. It's a company that I used to own in my portfolio. I've talked about this company a lot. This is probably going to be one of the probably similar to Microsoft in the future. So maybe in the next 10-15 years, if it carries on and basically the guy, the CEO comes down and focuses on the business side of it, this company has the potential to become the next Microsoft. It has a wide economic moat, $222 per share right now, EPS of $1.60. PE is very expensive right now, it's 140, but forward PE is about 27. PEG ratio below 2, which is good. Price to sales is actually quite low as well, but obviously not as low as we wanted. Profit margin is very, very low. This company has only started making profit not long ago. Return on equity is about 2%. Current ratio just on 1, so that means they have got enough money to cover it. Free cash flow right now is $7.56 billion. Total return in the last 10 years, we're looking at about 16%. 16% growth expecting this year, then 26% after that every single year. 13% discounted right now. $255 per share is where the price is at. The next company we're looking at, again, is a famous company that everyone knows about, is the AMD. It has a narrow economic moat. It has $106 per share price right now, and EPS is a negative right now, which is quite surprising. So for that reason, it doesn't have current PE, but it has a forward PE of 38, which seems maybe a little bit expensive. But price to PEG ratio of just below 1.5 is actually not bad at all. Price to sales low, basically about 8. Profit margin obviously non-existent right now. Return on equity almost non-existent. Current ratio we have about 2, so that means they've got enough money. They've got $1.87 billion of free cash flow right now that you can use. Total return in the last 10 years, we're looking at about 40%, 50% expected to grow, about the earnings to grow about 50% this year and then of next year, sorry, and the growth estimate for the next 5 years after that is about 9%, 18% discounted right now. The price is not $3. Let me just double check that. Of course it's not $3. There's a mistake there. Yeah, it's 130, so it's not 18. Of course, 130 fair valued when we look at that. So I can just quickly change that. Okay, so that is AMD. The next one that we're looking at today is Microchip Technology, another tech company, another chip company as well. It has a wide economic mode, $70 per share right now, EPS of $4.32. PE is right now 18, which is the lowest in this group that we're looking at today. And the forward PE, this is a very mature company, by the way. Forward PE, we're looking about basically about 12, let's call it 13, which is really low. PEG ratio, not great, but price to sales is actually cheapest in this list. If you're using that, profit margin 27%, 37% of return on equity. Basically, current ratio is just 1. Free cash flow, we're looking at about $3.3 billion. Total return, we're looking at about 16% in the last 10 years. Growth estimate for the next year is 1%. After that, it's about 12% every single year. Hence why I've included this in this list. So every single year in the next year is growing in double digits, which is quite good. And total return, basically, Morningstar valuation right now, they say that it's about 12% discounted. $90 per share is where it should be. Right now, it's basically about $11 below where that is. Next company and the final one is one that I've added to my portfolio not long ago, and that's Palo Alto Networks. It has wide economic mode, $245 per share, EPS of $1.28, PE right now 191. That's absolutely crazy. But forward PE, we're looking at about 46, which is okayish for this type of company. PEG ratio just below 2, which is good. Price to sales, we're looking at about 12, and then profit margin almost non-existent right now. Return on equity non-existent almost. Current ratio just below 1, and free cash flow of $2.63 billion. So I'm not worried the fact that they might not have enough liquid to pay off any current liabilities, but I'm sure they can use that to cover this. Total return in the last 10 years, we're looking at about 32%. Next year, they're expecting about 20% the earnings to grow. Then 27%. Fair valued right now, $245 per share is exactly where the price is at right now. That's why it is flat right now when it comes to that. So there you have it. That's 5 different companies in technology companies. Again, they're growing their earnings really good. They seem to be discounted right now. Obviously, do your research and so on. When you're looking at technology companies, not tech companies, but growth companies, you can't just rely on the PE. You're going to have to look at the PEG ratio, forward PEs, and everything else taken into consideration, and how fast this company is growing. Because what we tend to do as investors, right? I've invested in this company, and the reason it is because of this. Because of the future earnings, I think the company is worth whatever the PE right now is. So I'm kind of betting on this happening. If that doesn't happen, it's a bit of a risk, obviously. And that's why I would like to keep this type of companies maybe about 1 to 5% of my portfolio. I wouldn't have like 30-40% of my portfolio in this type of companies just in case. I'd rather have basically companies that are quality, and at the same time kind of basically have a lower beta, meaning they're not too risky, if you like. Okay, now I'm going to show you one last thing, and that is the Sharia compliance side of things. So in terms of business activity, all of these companies are fine. Interest bearing debt, the highest we're looking at here is Microchip Technology, and then when we look at interest bearing debt, basically Palo Alto is the highest, and it's got about 7%. So it seems basically absolutely fine. So if you're really interested in this type of content, please like the video, subscribe to the channel, obviously, and join us on the Discord. It really helps the channel. It takes a lot of time and effort to put these two things together, so it kind of motivates me to keep going. Right, ASML is basically one of the companies that I own. Just to be transparent, I have 8 shares of that company right now, up about just below 1%. And then Palo Alto Networks is the other one. I'm up about 14%, seeing as I bought 5 shares of that company. That's the 2 that I own on that list. I hope you're having a wonderful day. Assalamu Alaikum.